Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, April 10, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. Now, you're going to notice some additional or different things on the chart in terms of the resistance lines that I've drawn on the chart. I'm going to get to those in a couple of minutes. First, I do want to make mention of the fact that I really do appreciate all the comments that continue to come in from these videos. I like the comments about what you guys are thinking. I like the different perspectives on the market. That's what makes a market. It's good. It's healthy. Keep them coming. I really do appreciate it. I try and answer each and every one of those comments. I absolutely love reading them all, so thank you very much. Keep them coming. Continue to like the videos if you like the videos. It helps get the word out, and certainly if you share the video with friends, with family members, with other people you know that are interested in the markets that might benefit from these videos, that's also helpful. We continue to get the word out. The more the merrier. I love the interaction with all you traders out there. Thank you very much. Now, let's get into the charts and pick apart exactly what's going on here. So we had a pretty big healthy up day across the board. The S&P 500 was up almost 44 points. That puts the Spider up about $4 on the day, roughly 1.5%. The NASDAQ Composite was up 144 points, over 2%, and the Dow was up over 400 points, about 1.8% for the day. That's a big, healthy up day for the markets. And what that is doing is it's basically trending toward the top end of the range. Now, I'll get to the higher numbers in a minute, but here's your range. So we have the top end of the range and we have the bottom end of the range. And obviously, as you see so far, each and every time we got to the bottom end of the range, that's somewhere in the neighborhood of the 200 period moving average, we've managed to stage a rally towards the top end of the range, or at least more than halfway point, and then we either continue on to the top end or we've come back down. So we still continue in this bearish pattern. The long-term trend or the long-term picture on this market hasn't changed. Even though we had a big healthy up day, the long-term outlook hasn't changed at all. It can change. It could certainly turn bullish if we begin closing on the daily chart in this range up here above all the moving averages. That could certainly turn the trend back up, but we don't have that today. We'll leave that for another time. Let's talk about what we do have and where we can go on the upside if we continue this rally. And by the way, I think in the short run, meaning the next few days, I think there can be some legs to the upside in this market. So here are the changes that I've made. The 266.75 is not any longer as important as it once was when the chart was all the way down here, or when price was all the way down here. We came into the 20 period moving average today, and we obviously reacted slightly off the 20 period moving average. But today, rather than finishing near the lows, for example, yesterday, we had what's called a fade at the end of the day. The market turned over or rolled over at the end of the day. We finished not on the lows, but near the lows. Today, there was the opposite effect. We finished not on the highs, but near the highs. I think that's an important development. I think what that does is, at least in my book, it gives the market the upside bias for the next day or so. So here are my upside objectives if the market, now that's a big if, but if the market should continue higher. 266.75 should still provide at minimum of an intraday level of resistance to the market. Nothing's changed from that standpoint. If we should get through there and continue higher, the next area of resistance should come in at 268.50. It's give or take. Maybe it's 268.75, maybe even 269, but in that ballpark, in that neighborhood. Now you'll notice that it comes right underneath the convergence, or what will be a convergence, of the moving averages, the 50, which is the blue trend line, and the purple, which is the 100 period moving average. They are converging, and we shouldn't be surprised to see some kind of a spike through this area to at least touch the convergence of these moving averages. Now, if the market, and it's a big if the market should have really a whopper of a rally from where we are now, and if we're going to continue higher, and this isn't in a straight line, right? This is nothing that's expected, at least in my book, to happen tomorrow, but it certainly could happen over the next several days if we caught a spark on the upside in the market all the way up to 271.15. Now that does put the market above the moving averages. Do I expect the market to close up in that area? Not necessarily. Can we get a spike up to those areas? It's probably not a high probability, but it is a possibility. Would that be short selling territory for me? Yes, it would, without a shadow of a doubt. For me, in terms of a risk-reward ratio, that would be a stone cold short. As a trader, let's discuss for a second what's the best way, if you're interested, to short the market up in some of these areas, whether it's 268.50 or all the way up to 271.15 or anywhere in between. What's the best approach to take? Well, it's really the same thing that we've been talking about on the downside, looking for a low in the market. We're looking for signals of a trend change. We're looking for a reversal. We're looking for either an intraday reversal. We're looking for a doji candle on the daily chart potentially. This way, it gives us something to trade against. Even a reversal candle on the daily chart would give us something to trade against. On the hourly chart, it also gives us something to trade against. What do I mean by trade against? What I mean by that is, once you have a signal of a trend change, let's just say for argument's sake, the market puts in a tail candle, a doji candle, call it what you want. Let's say it puts in a candle similar to this, okay, on the daily chart. Now, if that's the case, and we can call this a doji candle, but it's also a tail candle. So if we have a large wick and we finish below the halfway point, for example, that qualifies in my book as a tail candle. So if we have a tail candle on the daily chart, for example, then we have something to trade against. What that means is we know that if any subsequent day closes above the high of that tail candle, then we have to move out of the trade. The trade is off the table because the market will be moving higher above the high of that signal of a trend change. We don't want to be in the market unless the trade is working in our favor. We don't want to trade on what I like to call hopium. We're hoping the market goes back in our favor. If the reason we took the trade is no longer evident on the chart, and in this case, the reason we took the trade would be, for example, a tail candle or a doji candle. If that no longer exists because we've exceeded that high, so let's say 2 days later we find the market up in this area and it closes up in that area, we have to move out of that trade. It's no longer the same reason we took the trade. This signal of a trend change would generally send the market lower, and if that trend change signal all of a sudden got negated by a close above that, either a day or 2 or 3 later, then that trade is off the table. It's no longer valid. It didn't work. You can't be in the trade any longer. That's what's called having something to trade against, having something to lean on. I'm leaning on the high of that tail candle in that prior example. Before we move on to the other markets, I want to digress a little bit. I want to talk about the media, I want to talk about the news, and I want to talk about the markets. Think back over the last week or two, for example, or even the last several days. What kind of news have we had? We've had nothing but negative news. We have Syria that just popped up in the news. All of a sudden, we're talking about going to Syria or adding additional troops to Syria based on the fact that we've now seen some more chemical attacks, and that's kind of a red line. And we're not 100% sure who did that. You know, one faction says it was Assad over there, and there's another faction that says it was somebody else. I don't know who it is. I don't know that anybody knows who it is, but nevertheless, it seems to me that our government is intent on getting involved or further involved in Syria. That could be bad news any way you want to look at it. Russia's over there, and there's nothing good about that. You can't draw any good information about that. So that's in the news. That's negative. We also have all the Trump news. We have the Russia collusion story that never ends, or I should say soap opera that never ends. Now we have a raid on Trump's personal attorney of his records from his office, his home, his hotel room, all that stuff. You've seen all that in the news. I don't need to explain what the news is. You've seen it. So it seems to me that there's something underlying Trump's attorney, that at least the special counsel Mueller has an inclination that he can draw information from him that's negative on Trump. So that's negative in the news. Certainly, anytime a president is under fire, it's negative news. It's not good for the country. It's not good for anybody. Whether you like him or don't like him, it doesn't matter. It's just not a positive environment. Then we've also had in the news over the last couple of weeks, we've had the saga with Facebook. And Facebook's been blamed for some of the market downturn. I don't necessarily believe that. However, that's what the media's been reporting. And today, Mark Zuckerberg has been testifying in front of, I believe, a Senate hearing, and he's probably going to be there for a couple of days. I'm not sure exactly who he's testifying to tomorrow, but either way, any way you want to look at it, Facebook's been in the news, it's been negative, and according to the media, it's been weighing on the tech sector or the NASDAQ composite. And here we are with the market up today in the face of all that news. And herein lies my point. And I've got on this soapbox before, and I'll get on it again. The point is that you can't pay attention to the news. It's not directly related to what the market's doing today. That's not the way it works. Sure, on a very short-term basis, a piece of news can hit the tape and next scene shows the market is spiking up or dropping lower. That certainly happens, and that's not what I'm talking about. I'm talking about the fact that there's been so many people out there that are calling for a market collapse based on all these news items, and here we are rising in the face of all that. And here's my point. My point is sentiment. The market doesn't necessarily collapse when the sentiment is extremely negative. Sometimes you have to think of it like we live in opposite land. For example, the market may rise for another couple of days, and everything will look fine. The market will look bullish. The media will tell you it's bullish. The price will be rising, and it looks like you're missing the rally and that you want to hop on board and catch the momentum ride higher. And herein lies one of the ways that the market is designed to make as many traders and investors look like fools as possible. Remember, the market's job is to trick, trap, and fool as many people as possible. So until and unless we begin closing daily above these moving averages, then I'm still looking for another leg lower in this market. So here's a scenario. Let's say the market goes up tomorrow, the market goes up Thursday, maybe even on Friday leading into the weekend. And let's say we get up to this level, okay? Then what happens is we have a potential for a lower high once again. So we have a high, a lower high, and look at the symmetry here. We have the potential for another lower high up in this neighborhood. Maybe it doesn't get up this high. Maybe it's over here somewhere. But another lower high could certainly send the market in the opposite direction if we get sellers to emerge. I'm telling you that there's a lot of overhead resistance in this zone right up here. So somewhere in this zone, there's a lot of overhead resistance. What is overhead resistance? Overhead resistance is where there's going to be a lot of what's called supply in the market. Supply meaning that's where sellers will emerge. Why would sellers emerge in this area? Well, it's quite simple actually. And it really coincides with, let's just talk about this open gap for a second. So here's a gap area. It's a gap fill. And so what'll happen is markets like to come back and fill open gaps, whether they're on the upside or the downside. But what really is an open gap, and why do markets find resistance at open gaps on the upside and support at open gaps on the downside? Well, let's talk about resistance on the upside. So let's talk for a second about the buy the dip crowd. So what I mean by that is there's a faction of traders and investors out there that for a very long time, they've been right every time the market dipped lower. They were buying the dips thinking the market was going higher, and they were right for a very long time, and they'll be right again. But think about the people that bought the dip when the market came down in here. Okay, so they saw the market, first it was rallying up, and they said, okay, we're recovering, I'm in the market, and then it comes down a little bit, so they start to accumulate whether it's an index or they accumulate stocks, whatever it is, it's not important what they accumulate. The fact is the buy the dip crowd is buying the market because it dipped lower. And then what happened, let me clear up the chart a little bit. What happened is you see this gap. So from one day to the next, we gapped lower and we never went back. So we came all the way down to here. Now there are people out there, whether they're institutions, whether they're individuals, it doesn't matter who they are. There are people that bought the market in this general zone. Now, what they've been experiencing since the market went down is an uncomfortable feeling because they have losses, or at least paper losses, in their account. We all know it's an uncomfortable feeling when you see paper losses in your account. And what do you say when that happens? Okay, please let me just get back to even and I'll never ever do it again. If I get back to even, I'm out of this trade, I'll reset the clock, and I'll be happy just to scratch out of this trade or these stocks. So now let's take a look at the market and say, what happens if we do rally up another few points, and it could be as high as another, 35, 45, 50 points in the S&P. If we got up to that level, we're going to see that overhead supply come in. We're going to see sellers emerge that are happy to get out even from the time the market gapped lower. Now, that's not the only reason. That's one of the reasons. There are certainly other technical reasons, but certainly for me, the overhead supply or overhead resistance certainly will play a big part in potentially putting in a third pivot or second lower high. And just as a reminder, here's the high, here's your first lower high, and somewhere in this neighborhood could potentially be a second lower high, and that could certainly send the market in the downward direction. All right, so we deviated a little bit from what we normally discuss in these videos, but I think that was important. I think it was a decent lesson that should make some sense. To me, it's the type of thing that I've seen over and over again, and I kind of see it setting up again. In addition to that, if the market by chance, and I'm not saying it will, but it certainly can, if by chance the market trades up through this week, so Wednesday, Thursday, and Friday, if there are 3 more up days, or I take that back, it doesn't even have to be 3 up days, but if we actually make a new high, and not a new high, not a new all-time high, but a high in this range, so I shouldn't have said new high, but a high in this range, if that occurs on Friday, for example, that's going to be an extremely important development and something that I go over in detail in the course at Lazy E-mini Trader. Those traders that have taken the course understand from a timing perspective why that's important. In fact, it's extremely important, and if that happens to coincide with some of these upper levels up here, that's going to be even more evidence that we're probably making another high, and that high should result in another downturn. So we'll see. I'm giving you a lot of if-thens, and as we know, the market never makes it that easy. It never does exactly what we want or what we anticipate happening. However, I'm just trying to give you the benefit of my thought process, what I'm looking at, and why. Let's go over to my favorite market leading indicator, the IWM, or the Russell 2000 Index. And you can see here that the Russell 2000 was up almost 2% today, 1.89%. And that was the leading index today, certainly better than the Spider, which was up a little less than 0.5%. And you can see where we came to on the daily chart, right into the convergence of these moving averages. The 20 is the red trend line, the blue is the 50, the purple is the 100. We came in to all 3 of them. It's a convergence of moving averages. We spiked through it a little bit and then finished right in the midst of those moving averages. One of the indications today from an intraday perspective was that the IWM was strong all day, and when that index is strong, along with the transportation average, the Dow Jones Transports, which we'll get to in a minute, when those 2 averages are strong, my favorite and second favorite market leading indicators, it's unlikely we're going to have a rollover intraday. It's unlikely that we're not going to finish strong on the day. Unless one of those 2 averages roll over, then we always have the possibility for a market rollover at the end of the day. But that's not what happened today. They stayed strong, so my expectation intraday was that the market would stay strong, and it did. I think it's worth taking a look at the VIX. With the type of up day that we had across the markets, was there any damage done to the bullish pattern on the VIX? And the answer is no, not at all. In fact, we stayed above the 20 and the 50-period moving average on the VIX. We're comfortably above the level where this bullish pattern would actually be broken apart. Again, something else that's taught in the course at Lazy E Mini Trader. These patterns are paramount to learn because they keep us in check in bullish positions, and regardless of whether we're looking at the VIX or any other chart, the point is that when we have a bullish pattern, we can be long whatever market we're looking at during that bullish pattern because we're expecting the market to release the energy to the upside out of that bullish pattern. Even more importantly, we know where we're wrong. We know where this bullish pattern breaks apart. We know where it fails. And if it fails, we can no longer be in a position playing for the release of energy to the upside because the bullish pattern, if it fails, will release to the downside, and we don't want to be caught in the market on the wrong side. Same thing on the flip side for a bearish pattern. Again, these are taught in detail in the course, and if you're not familiar with these, you really need to get familiar with these because the majority of the money that's made in the market is made from these patterns, at least from my experience. Here's the transports. So in the big scheme of things, has anything changed from this bearish pattern that exists in the transports? Not really. So this is really a bearish pattern that won't break apart for quite some time. We could come all the way up to the top end of this channel and still be intact for the bearish pattern that should still release its energy to the downside. So even though we had a nice big up day in the transports, up over 100 points, 1%, it wasn't a tremendous day for the transports, all things considered. So the IWM was up 1.89%, but my second favorite market leading indicator was only up about 1%. It's a puzzle piece. I put it on the table. I've got it in the back of my mind. I know the transports, while they were up today, it wasn't a tremendously strong day for the transports. Gold continues to edge up a little bit. We're above the moving averages. That's slightly bullish. There has to be at least an upside bias to gold market. However, again, there's no definitive clear picture of where this market is going. If I had to take a position, I'd have to be long, but I'd have to be out below the moving averages. That's the best I can do for gold. If we have any kind of a sell-off in the market, my expectation is we'll probably see a pop higher in gold. If the market continues higher for the next few days, I think gold is more prone to just chop around back and forth in this range. So there's really nothing I would do currently with gold. How about crude oil though? So check this out. So going back a couple of days, several days ago, we drew in this trend line here, and it wasn't us drawing or me drawing the trend line. The market drew the trend line. So before crude oil came into this trend line, and that was on the 6th of April. So the other day, we came into the trend line. We drew the trend line before that. So we drew the trend line saying, as long as this holds on a daily chart closing basis, then we're probably good. If this trend line breaks, then we'll have to come down and test some lower levels. And then the first major area of support would have been down here around 60, just north of 60, and then all the way down at 58. But what happened was we came into the trend line, the market was supported by the trend line, and then Monday we had a nice healthy up day, and then today we had a huge rally to the upside, and look where we are, closing above $65.29. That's a level we identified so long time ago. We came up to test it. We pierced through it or spiked through it a little bit, failed, came back. Ultimately, this was a bullish pullback pattern, and here we are right back up again. This is bullish for crude oil. It puts back on the table the $73, $74 area that we've been talking about for quite some time. Now, here's something else from an intraday perspective that I'll show you I think's kind of neat. So when we came back up to the 65.29 area that we've had this line in here for quite some time, look what happened. The market came right up into that area, but wasn't ready just to blow through that area. We had to consolidate underneath that area and build some energy before heading higher. That tells you that that area, or that 65.29 zone, if you will, could be 65 and a quarter, 65.30. My number was 65.29. it tells you that that area was important to the market and the market had to buy some time or eat some time off the clock, consolidate for a while, build some energy before making the next move higher. That tells you that that price level remained important to the market, even if it was just for an intraday period of time. And that's about everything I wanted to and intended to discuss tonight. This video got a little bit long in the tooth, but hopefully it's been helpful. I like mixing it up each and every day, at least with a little bit of information that we don't discuss on a daily basis, because I think that's how we learn in little bits and pieces at a time. And if I can add at least something new, even something small, but something new each and every day, then hopefully you all will benefit. And with that, I'm going to give it a wrap here. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.